Alrighty, how's it going, everyone? Welcome to the Sunday macro wrap up for Sunday, July 6th. I hope everyone had a fantastic July 4th and was safe. No hospital visits, I hope. But today, we're going to be taking a look at some of the charts as well as last week's macro data. This week is a little bit quiet in terms of macro releases. Really people are going to pay attention to the July 9th expiration of the tariff pause. We've been getting some recent headlines today that might be pushed back even further into August. So we'll see what happens there in terms of the headlines. So it might be a little bit of a headline dominated week, right? And so we'll get into not only that, but what the charts are telling us as well. For those who are joining us on TikTok, Instagram, and YouTube, the way that these Sunday macro wrap-ups work is that the first 30 minutes, this is streamed on our socials, and then the last 30 to 45 minutes is offline only for our Macro Optics community members. And if you guys want to start your 7-day free trial of that and join the discussion afterward, because we're going to be going over some actual ideas for the week, you can go ahead and start your 7-day trial by going to the link in the description below and seeing that there. All right, so before we get into the charts here, let's go ahead and take a look at some of the different highlights from last week. Now, the title of this video is specifically called "The K-Shaped Economy Widens" because with the pass of the big, beautiful bill that happened, as well as when we take a look at some leading economic indicators, we can see that for the bottom 50% of the United States, it's really not looking too good out there. With the labor market, with, just growth in general, as well as with inflation remaining high, this is really putting downward pressure on those who have a lot of debts, as well as essentially just everyday goods and services, right? While the top 1%, right? These are people who own who own the majority of assets, who are also, they have cash flow from those assets, and most of it is in debt, so they're not necessarily taxed on it because you can't get taxed on debts. That type of economy is seriously benefiting the top 1%. I mean, they are absolutely ecstatic. And, the thing that I was trying to talk about this week was that, it doesn't really matter who's in the White House. All the government knows how to do is go further into debt and to spend our future money today, right? And so there's just two different avenues in order to take that approach. And so what Trump is trying to do with this big, beautiful bill is essentially trying to spur economic productivity by just doing a lot of borrowing, right? And so the idea is that if we can get the debt to GDP ratio lower, which I can bring up a chart of that while I'm talking here, and because this is really the chart that he's focusing on. Let's see, we'll do total federal. Yeah, because as of right now, the debt to GDP ratio is 120%, which is astronomical. This is something that is completely unsustainable. And even before that, right, in basically between like 2013 to the pandemic, it was around 100 to 102%, which is still pretty high. But now it's 20% higher with the onset of the effects of COVID. And it really hasn't been this high since World War II, right? And so there's two ways you can go about getting the debt to GDP ratio down, right? Just like any type of ratio, you could either lower the numerator, or you can increase the denominator, right? Both of those two will get the ratio down, right? And so what Trump is trying to do here is they can't do much about the debt. In fact, they're going to continue going further into debt. But if you could get GDP higher, then that will bring down this ratio. And so they're hoping to, even though they're going further into debt, they're hoping that productivity will just go crazy. And I think that is a very interesting gamble. Um, one thing's for sure is that asset prices will benefit, and those who own a lot of the assets will continue to outperform. And so, um, not necessarily what the majority of Trump voters voted for, right? But here we are. So let's go ahead and take a look at some of the data here coming out last week. Chicago PMI, looking at the last 10 years, that still remains at low levels at 40.4. When taking a look at the last 10 years, you can see how it peaked in 2021, and it's at pretty much the same levels right now as it was during the depths of the COVID crisis. If we go back even further than that, I mean, look at where we're at right now in terms of historically, right? Going all the way back to 1970. Uh, the last time that it was at this level was again COVID and then essentially the great financial crisis. So the Chicago PMI is showing very poor numbers. And this is just a testament to what the real economy is actually going through. And so when you see on TV people like Powell saying that the economy is fine, no, it's not fine. So that's just one metric. Dallas Fed manufacturing, that still continues to be in contractionary territory at negative 12.7%. Going back to, again, history here, you can see that this is still at pretty low levels. So manufacturing still at low levels. United States ISM manufacturing, it's been creeping up from the lows around June of 2023, but it is still in contraction. Anything above 50 is an expansionary territory. And so you can look at this as a positive rate of change for manufacturing, but really you would want to see a sustainable trend above that 50 line in order to get a better read or a better, essentially a better call on manufacturing actually trending higher. But yeah, so this remains in contractionary territory, and it is technically having a positive rate of change. So you would need to see that really start to increase. But what's interesting is that when you take a look at the employment component of the ISM manufacturing, that is still trending lower, right? So just taking a look at like a 2-year stacked trend, right? June of 2025, we're at 45 points. Oops, let's take a look at June of 2020, June of 2022, even lower than that. June of 2023, 48.1. So yeah, we're still, it's a pretty slow grind downward in terms of the employment component for manufacturing. New orders continue to trend lower. Pretty huge drop off, right, from the beginning of the year so far this year. That was very interesting. And then prices paid continues to go higher. And so it's interesting. You have the contraction continuing to go on in manufacturing while prices continue to go higher. And a lot of that does have to do with some of the tariff situations going on. We also got labor data, right? So the first of every single month, or the first week of every single month, is always having the new released numbers for the labor market. And so for job openings, you did see a slight acceleration, but as you can see, from looking at this going all the way back to the peak of March 2022, it's still at pretty low levels. Job openings do have to do some work here in order to start to trend higher. Let's see. Light vehicle sales continued lower. A lot of people were taking a look at the ADP job numbers, which went negative for the first time since March of 2023. So a lot of people, this was a huge red flag, and people after this report were saying, all right, now the Fed has to cut because jobs are contracting. You had the unemployment rate come down, which is, still good news. It really hasn't gone above that 4.2% level, but it's still remaining above 4%, which is still, it's still pretty low, but a large spike from here would probably be what the Fed is looking for in terms of cutting. So even though some of the soft data is showing that there could be contractions, the Fed really is hyper focused on the unemployment rate. So that's pretty much what's happening here. Average hourly earnings year over year continue to trend lower. So, the amount of money that people are making on average continues to slow. This was the big news from what we saw last week, right? We had non-farm payrolls actually accelerate. When looking at the 1 year trek, it accelerated to 147,000. The market was praising this because it was a month over month increase, but it was, it was a slight increase, but pretty much the similar level since April of this year. And then when you take a look at a 10, let's go back till 2021, you can see that still, this isn't anything to be too crazy excited about. It's still at pretty low levels. But what's interesting is that when you take a look and divide it between government as well as private jobs, right? Because remember, the ADP report only focuses on private jobs, while the non-farm payrolls report focuses and combines both government as well as private jobs. And so when we take a look at government jobs, that actually had a fairly large acceleration. This was the largest number that we've seen really since, let me see here, since March of 2024. And so this was, pretty much the largest acceleration in government jobs in 15 months. While contrast, you have private jobs actually got cut in half. So in May, it was 137,000, and in June, last month, it was 74,000. So that's a pretty big drop in private jobs, which is what really matters, right? Most people, you have to look at the private jobs numbers in order to get, a better read on what the actual labor market is going through. And so, this is a pretty large drop here. Definitely not something to ignore. And that is more of a reflection of the ADP report. So those are actually, despite what the headlines say, the non-farm and ADP report are pretty much in line. Manufacturing payrolls continue to contract. And then finally, at the end of the week last week, we got the ISM Services PMI, which that did have a decent acceleration back into expansionary territory ever so slightly. But, as you can see, since the peak in October, this has been the general downtrend. Employment, had a pretty large drop off in services as well. Let's see if we go back 10 years. Yeah, so if you go back doing a 10-year look back, as you can see, this is fairly low to the same levels that we saw back at the middle of last year during this time. New orders had a decent rebound, but still remains fairly lower. And then prices remain higher, similar to manufacturing. We also got a bunch of global S&P global manufacturing PMI as well as services PMI numbers. Instead of going through each and every one of those like we just did for the United States, what's interesting is that when you take a look at this World PMI Diffusion Index, you can see that it generally was an acceleration, right? But still, from the peak in November, let me make this a little bit smaller. From the peak in November, this has been declining, for pretty much 7 straight months, and then we finally saw a little bit of a jump here. And so that is a positive rate of change for global PMI. And so that's why you're seeing a large acceleration globally there. Decent rebound. When taking a look at the Atlanta Fed's GDP nowcast, that continues to grind lower as we get some of this data that is showing that GDP estimates are far lower than that initial estimate, around 4.6% at the beginning of, or at the end of May there. The Cleveland Fed has inflation with their inflation nowcast remaining sticky. So core CPI is going to remain around 3%. Headline CPI is going to remain around 2.6. PCE remains near 2.4, 2.5. And then they have core PCE remaining around 2.7. So despite the slowing growth and the employment, the Cleveland Fed has inflation remaining pretty sticky, right? So essentially no progress. which is pretty interesting there, which we agree. I mean, when you look at oil, it still remains in a bullish trend and has been accelerating over the past week. And what does that translate to? Target rate probabilities for the Fed meeting this month, 95% chance that they still remain paused, right? So there's been a lot of people talking about that the Fed should cut this month, but according to futures markets, that is not going to happen. And then also what's interesting after this week was that just 1 week ago, the probabilities for a Fed rate cut for the first one was at 74%, and the chance of a pause was around 8.6%. Again, this is the September meeting. But after last week, having the better than expected reports, the chances of a pause continuing went from 8.6%, jumped up to 32%, which is a pretty large acceleration there. There's still a decent lean towards cutting by 25 basis points by September, which, we should be seeing a cut by then, but we'll see. It really depends on these next couple months in terms of the actual data, as well as we're still unsure about all this tariffs, all the tariff news. So that's what I'm seeing there. Again, all this is pointing to higher interest rates, stickier inflation, while the employment situation is continuing to deteriorate, possibly at a faster pace now. And then also, too, you have leading indicators like ISM manufacturing and ISM services still showing weakness, right? So in order for stocks or in order for an actual recovery to happen, you need to start seeing inflation coming down incrementally while the other component, growth, starts to reverse higher, which we're not seeing yet. So yeah, I think that the market has been enjoying the cooling off of the Middle East tensions, as well as some of the tariff talks. I think a lot of the tariff headlines have lost a lot of their sting, right? So we'll see what happens this week. Again, the official due date is July 9th, which I think is, what is that, Wednesday? Yeah, but I think I saw a headline today that Scott Bessent was saying that they might push that to August. So we'll see what happens there. Let's go to the charts here. Dollar continues remaining in bearish trend. This is pretty interesting. With Trump's big beautiful bill, economists estimate that it's going to add around 3.3 trillion to the national deficit. That'll definitely get the dollar down, right? I mean, that's a huge stimulus. And so, you have dollar having a continued bearish trend. Foreign currencies have been liking this environment, specifically the Swiss franc, British pound, as well as the euro, all of which are in bullish trend. Taking a look at rates on that news with Trump's big beautiful bill, look at what the 10-year did. Massive move to the upside. Look at what the 2-year did. Massive move to the upside. Right? This is when you have this type of move, this is what's called a bear flattening, which this is a huge signal that the Fed probably won't cut for that long, or cut for very long. So yeah, this is a huge hawkish signal by the bond markets. Based on that, bond volatility continues lower, so I'm not seeing too much of a risk right now, meaning that I don't think that the market's going to crash, right? There's nothing really pointing to that. The volatility index of the S&P, this is at levels where you want to continue to raise cash on stuff, right? So if you're trying to chase green, that's really not, what you want to do here. Oil, it did have a nice little spike here, but it's back down to $65.68 per barrel. Still remains in a slight bullish trend there, but it has lost trend, as well as gold. Gold has also lost a decent amount of trend. Still remains bullish, but it would need to have a decent week this week in order to maintain that bullish trend. So yeah, gold is teetering on losing its trend there, which is pretty interesting. Um, Copper had a pretty large acceleration last week, and that continues in bullish trend. Same with platinum as well as palladium. So yeah, so a lot of these industrial metals have been continuing higher, which, that's also a signal that inflation is going to remain sticky. Bitcoin had a decent pop last week. It's going to try and, or it tried on Thursday of last week, right before the 4th of July, to break through that pesky 110, 111K level. We'll see if it'll try it again for a fourth time, but it did get rejected from that 110 level, which is pretty interesting. When we take a look and we add volume here, so you can see that volume had a pretty decent drop off on this. So, that is technically a bearish divergence when you see a large, just huge drop in volume, as it's trying to test this higher level here. So I wouldn't be surprised if we saw further correction in Bitcoin, possibly down to 105. We'll see if that happens though. But the big thing with Bitcoin is that you had to notice the just incredible drop off in volume. And yeah, you can see that there. So the green line right there is the 1 week average, which again, this just had a huge just drop off here. And I've pointed this out before, but let me get rid of this table. Let me zoom out real quick here. So when you take a look at Bitcoin's volume, I mean, it's very low from where it's at. In fact, if you scroll back far enough, I don't know if it'll show it here, but essentially, volume hasn't been this low. Average volume hasn't been this low since 2018. And so typically when that happens, it's gearing up for a large acceleration in volume at some point. And so I wouldn't be surprised within the next month, 1 to 3 months, that Bitcoin is going to have a pretty large move. Now I'm not sure which direction, as that gets closer, or even after it happens, we'll probably have a better idea. But yeah, the big thing with Bitcoin to notice last week was just the incredible decrease in volume. All right, we beat that dead horse. Let's go ahead and move on. What hasn't been losing volume, when what's actually been accelerating with volume, has been Bitcoin miners. Look at Bitcoin miners, Bitcoin miner stock, or Bitcoin miner ETF WGMI. This has been one of the best horses in our group. We got in around mid-May, around $15, or in between $15 and $16 on this day right here. And so, since then, this has been one of the better performers in my own portfolio over the past few weeks, which is up nearly 62%. So that one has been nice to see in the PA. I have been taking profits on this one, looking for the next correction, but I'm not out of it. All right, S&P 500. Right at the top of the range here. Let's go ahead and bring up where is it here? Bring up the trading ranges model. Yeah, so taking a look at the top end of the range here, it's right at that upper bound at 62.79. Right, the upper bound on the ranges is 62.86. And so this is not where you want to keep chasing. If you've been long the S&P, again, this is a great time to take profits, not to chase. So that's what I'm seeing there. Russell 2000, same or similar. This has been, increasingly, bullish. So small caps continue higher. That's definitely a risk on type of mode. And then in terms of mega caps, the big one last week was NVIDIA and semiconductors. Yeah, a lot of these continue in bullish trend except for Apple, as well as Tesla, both of which remain in bearish trend. Oh yeah, as well as Berkshire. Berkshire remains in bearish trend there. All right. Well, When it comes to this week, again, it is summertime, so volume is generally lower during the summertime, as well as there's not a lot of big news except for the FOMC meeting minutes on July 9th, which is on Wednesday, as well as some of the tariff news. So, yeah, the big thing is don't FOMO in the market, be patient. There will be another opportunity in case you guys haven't been, or in case you guys missed out. For those who are in our macro optics community, they have definitely not been missing out. We've been in a lot of different opportunities that have been paying us. So with that, we'll go ahead and transition over just into our macro optics community members. For those who are on the Zoom call right now, just hang in there, guys, while I close the stream. Again, for those who are on the stream right now, if you guys want more access, you can click the link in the bio and start the 7-day trial in order to join the discussion afterward here. But I appreciate everyone for joining here. Have a great rest of your week there. Good luck. And yeah, have a great rest of your Sunday. Bye-bye.